President Trump just announced mortgage rates hit a 3-year low on social media. But here's what most people don't know. Rates moved lower this week while the Fed hasn't changed policy since December. What's really driving this market? I'm Ron Siegel, certified liability advisor, helping families build wealth through strategic debt management. Let's start with what happened this week. The 10-year Treasury note is currently sitting at 4.25%, and mortgage rates have been grinding lower for 2 consecutive days. Our daily rate index shows 6.19%, down from 6.21% earlier in the week. But here's the disconnect your clients need to understand. The Fed has not cut rates since their December meeting, yet mortgage rates are improving. Why? Because mortgage rates don't follow the Fed's overnight rate. They track the 10-year Treasury and mortgage-backed securities, which respond to different market forces entirely. This week, we saw bonds rally modestly in overnight trading, then give back some gains when markets opened. The pattern? Mostly sideways movement with a slight downward bias. Not dramatic, but consistent enough to create opportunity. The National Association of Realtors released their confidence index this morning, and the numbers tell an interesting story about market conditions right now. In December, 16% of homes sold above list price. That's unchanged from the prior year. But here's what caught my attention. 18% of buyers are still waiving inspections, and 19% are waiving appraisals. That appraisal waiver number actually increased from last year. Your buyers are still facing multiple offers. The average property is getting 2.2 offers. Days on market ticked up slightly to 39 days from 35, but that's likely due to the holiday timing and weather disruptions we saw in December. Cash buyers held steady at 28% of transactions. Investors increased from 16% to 18%. First-time buyers dipped slightly from 31% to 29%, but that's well within the normal range we've seen over the past few years. Bottom line for your business, this is still a competitive market. Your buyers need to be ready to move when the right property appears. There's a chess game happening in Washington that could impact rates later this year. President Trump is floating names for the next Fed chair, with Rick Rieder and Kevin Warsh emerging as the frontrunners. Market watchers give Warsh a 45% probability right now, with Rieder at 33%. Treasury Secretary Scott Bessent says we'll hear the announcement next week, possibly before Wednesday's Fed meeting. Why does this matter to your business? Both potential chairs are viewed as more dovish than Jerome Powell. If the economic data cooperates, that could mean more rate cuts in 2026. For now, the current Fed is expected to hold rates steady at Wednesday's meeting. Now let's talk about what's happening with household finances, because this affects your client's buying power. The latest personal income and outlays report showed consumer spending grew 0.3% in November. That sounds healthy until you look underneath. The savings rate dropped to 3.5%, the lowest since October 22. Real disposable income barely moved after adjusting for inflation. Here's the concerning part. TransUnion reported that serious delinquencies increased across all credit products, both month over month and year over year. Average balances on debt consolidation loans decreased from $6,756 to $6,247, suggesting lenders are tightening standards. Travel and leisure spending showed significant weakness. Hotel prices dropped 5.7% year over year in November, the steepest decline since the Great Recession. PCE price indices for car rentals fell 4.3%. Amusement parks dropped 1%, and admissions to movies and sporting events decreased 3.4%. What this means for you? Your clients may have solid credit scores, but their household cash flow could be tighter than it appears. This is where suitability matters more than just eligibility. This brings me to an important point about working with families right now. Strategy beats rate always. When you're working with buyers, the conversation shouldn't start and end with the mortgage rate. What matters is the household blended interest rate and how much money is actually coming out of their monthly budget. I'm seeing more families carrying higher rate debt alongside their mortgage applications. Credit cards, auto loans, personal loans, all eating into the monthly cash flow. That's why we focus on the total household financial picture, not just whether someone qualifies for a mortgage. And speaking of household financial health, Check out our featured tool this week, KeySteps. This is a free platform that provides credit monitoring, identity theft protection, and budgeting tools all in one place. Your clients can track their complete financial picture and protect themselves from fraud. You'll find the link on the right side of the dashboard or below the video if you're on a mobile device. It's rsrlinks.com/keysteps, rsrlinks.com/keysteps. Looking ahead to next week, we've got several data points worth watching. Monday brings durable goods orders for November. Tuesday, we'll see the Case-Shiller Home Price Index and consumer confidence. Wednesday is the Fed meeting at 11 a.m. Pacific time with Jerome Powell's conference at 11:30. Thursday gives us jobless claims and factory orders, and Friday closes out the week with the Producer Price Index, which will give us insights into inflation trends. The market will especially be focused on Wednesday's Fed decision and Powell's commentary about the path forward. The rate environment right now creates opportunity for families who are prepared and positioned correctly. Make sure your clients have access to tools like KeySteps to monitor their financial health, and remember that our agent tip of the week is also available on your dashboard. We appreciate you listening. Have a great weekend, and we'll speak to you again next week.